Hello everyone, today we look at my top 10 stock holdings from my $100,000 cash investment account geared towards a Canadian investor. Please let me know in the comments below what your top 3 holdings were in the year or what your top 3 will be next year. It was quite the year, markets are all over the place, and we can use today as an example of maybe how to build out a base portfolio with my top 10 holdings. We've all worked very hard for our money, and here's a good way to preserve it and protect in a down market while we try and get some upside as well. Now, I think today's video is a great starting point if you're looking for some ideas on how to build the foundation of your portfolio, so let's just get right into it. This should be a common holding you see, Spider S&P 500 ETF. It'll get you the entire US market with one purchase, 500 companies. And we've seen a nice history on its price growth, double digits over the last 5 years, both pre and post-COVID. A few bumps along the way, but should be a core holding in everyone's portfolio. I did say we're Canadian investors, but the US has the largest companies in the world, so you still need 20 to 30%, if not more. That's up to you in your portfolio. Next up, I love my Royal Bank. Dividend yield of 4%. It's been very steady pre and post pandemic. 4% dividend right there, and a 5-year growth rate on the dividend of 5.5%. Now remember, the Canadian government did not allow these banks for a few years to raise those dividends due to the uncertainty of the pandemic. So we do have a steady growing dividend there. Next up, Alphabet, parent company of Google. There is no dividend growth, but it's one of the biggest companies in the world, and you can see that the stock nearly tripled in that 5 years. So it's been a core holding, so you don't have to be married to dividends, but this is where I get some torque in my portfolio. And again, another little bit of overlap as well for your US exposure. However, I think it's a great holding, and another favorite holding is Enbridge with its 6.75% dividend, and dividend growth over 8%. They've slowed it down a little bit. Not a lot of capital gains recently, but I will take the dividend. And once again, if you like what you're seeing, please hit that subscribe button and give us a thumbs up, and we can bring you more content like this as well. So once again, Enbridge, why I love it. Big yield. I use those dividends to pick up other positions as well as the money comes in. Now, to get some international exposure, I use the BMO European High Dividend Covered Call ETF. Again, you don't see a lot of growth, but what you're going to see is a dividend almost at 7%. Gives me my international exposure. A lot of great companies on the other side of the ocean, and it just adds to the diversification of a portfolio. Back to Canada here, we're going with Suncor. 5% dividend, very little debt. Obviously, the chart doesn't look great, but we started picking up a lot of positions after the markets tanked when COVID started. They had cut their dividend, so they're not guaranteed. However, and that's why you got a negative dividend growth number, they've started to they've reinstated it. They are raising those dividends. They're paying off a lot of debt, and this company usually is able to buy up all the other ones when oil prices fall. Going back to some banks, BMO US Banks Covered Call ETFs. It's not been around for 5 years yet, but guess what? I'll take the yield in what's expected to be a sideways market. Some of the banks have been hit hard, but it's a good way to collect yield and have some upside as well. And back to this side of the border, TD Bank. So we had Royal, now we got TD. You're going to notice I have sets of 2 for a lot of my favorites. It's got great US exposure. Both TD and Royal are number 1 and number 2 consistently in Canada, and you've had some decent price growth as well as this close to 4.5% dividend. They also grow their dividend regularly, except for when the government wouldn't let them. But again, it's a staple in a portfolio. So the second of the oils is CNQ, Canadian Natural Resources. Never cut their dividend when oil went negative. They have very little debt. A lot of these companies could be debt-free within a year. and they've been paying down debt and boosting the dividend with special dividends. So that's why you see such a massive growth rate on the dividend. But these guys will be strong even with oil if it even weakens. So they're diversified as well. So again, Suncor and CNQ, the top two Canadian oil companies. And we had Google. Now it's time for Amazon. Again, no dividends, no dividend growth. However, stock price has done well. It's one of the biggest companies in the world. This is where you do get the growth. They've got their footprint everywhere. And even if you don't like them, that company is going to make money. So I think it's a great position to have in your portfolio. And please let us know what you think as well. And again, please hit that subscribe button. It helps us a lot. That's enough for today, and we'll talk to you soon.